again, and thank you for being here. Definitely, we don't need to introduce the topic. If you watch any news bulletin, you know where we are, the world we live in now. When I was a kid, watching a news bulletin was something occasional. Now, wherever we look, at least over the last 20 years, we see conflicts everywhere, and we have to deal with. They used to say change is the only constant thing in life. It seems now that geopolitical risk, handling it, mitigating maybe this risk, or living with it is the only constant thing. Thank you again. Please have a seat. Thank you. I want to start with Dr. Helen, Global Head of Geopolitical Risk. A really unique title and big responsibility. When you look at things now, and the complexity of this interconnected forces between economic fragmentation, geopolitical shift, and of course, financial uncertainty, how you go about approaching all this and how much really pressure it puts when you deal with all these factors on a global level as a global bank?
Great question, and I've never had to follow Idris Elba before in my career, so I will do my best. But I think to leverage the point he made, or the story he told, it's really about seizing opportunities. Normally I start with a bit of a health warning, so the opinions I'm expressing are my own, and not necessarily those of HSBC. And everything is Chatham House rule, so nothing's attributable. But with that in mind, I think we are facing certainly increased complexity. Everything from the simmering wars, Russia, Ukraine, the current situation in this region, to the geostrategic competition we're seeing, which is leading to securitization of trade, politicization of trade, protectionism, as well as the election cycle, the biggest election year in history. So it's really about navigating those shifts. And I hear a lot when we talk about geopolitics about volatility. The system is volatile. And volatility is actually, because I'm pedantic in that way, is made up of two things. One is the pace and scale dynamic change. And I think we can all agree that the scale of change, the pace of change that we're seeing in the international landscape is significant. The other piece of it is uncertainty. Mm-hmm. Now, I would say if you systematically look, examine, assess geopolitical risks, then you can narrow that uncertainty. And that's exactly what my team has been set up to do. A number of years ago, with significant foresight, we established an in-house capability in HSBC. And the day job is really threefold. The first is trying to understand what's in the headlines, trying to understand the implications for ourselves and our clients as a significant international bank. The second, and I think it's much more important, is horizon scanning, trying to understand what's not in the headlines but is likely to impact us and our customers. The third area is about opportunities. Geopolitical developments, and particularly for this region, are creating inordinate opportunities. As some doors close, some doors open. And the final piece of it is really most of my job, or at least part of my job at the moment, is talking to our clients, our multinational clients, our financial institution, our ultra-high net worth clients across the globe who are grappling with the same kinds of issues. And from the perspective of geopolitical risk, it's looked at very differently than other risk taxonomies. It's looked at as something that you can't actually manage. And I would suggest that's not exactly true. And that's a bit reductionist, and it's a bit of a cop-out. You can manage it. You can look at the questions, you can ask the right questions, look at them systematically, get a variety of sources, use academic rigor. You can inject the thinking, the assessments, the analysis into your processes, whether that's from a strategy or a risk perspective. Mm-hmm. And it can help you either make money or not lose money. Mm-hmm. So I think it's an effective capability, and my parents are less displeased that I didn't become a doctor or a lawyer. So there you have it.
Okay, I want to stay in the risk management approach. Ahmed, for Mubadala as a sovereign wealth fund, is your approach different or more fine-tuned, knowing that your investment strategy have a longer time horizon and you cater for more or less a more specific client or shareholder? How do you see this?
Thank you, Hisham. Listen, I think there is no doubt that every corporate, be it a sovereign wealth fund, an investor, an operating company, has to contend with risk in general, but increasingly with geopolitical risk. And this is an area that I think is becoming very important for boardrooms, for investment committees in their assessment. You may know that many financial institutions have established sort of geopolitical units, global institutions, to actually try to answer, to have a view in terms of this evolving landscape. So every investor, no doubt, has to contend with that. I think, from our perspective as Mubadala, as a sovereign investor, I think we think we take geopolitical risk into considerations, no doubt. But again, as you mentioned, our longer time horizon, we take a multi-generational view in terms of our investments. That puts us in a unique position where we have a bit more of an appetite, a higher appetite, and can manage and can withstand the volatilities that come with geopolitical risk. But nevertheless, it is an area that I think has to be watched carefully by investors. And as you're aware, Mubadala, as a predominantly private equity investor, we have portfolio companies that are operating globally. Take for example Global Foundries that was mentioned earlier. Global Foundries is at the crossroad. It's a battleground for geopolitical risk as a semiconductor manufacturing company. So this is a big portfolio company of ours. The way they manage their geopolitical risk, the way we help guide them when it comes to sort of areas. I think this is our portfolio is affected, no doubt. But again, I think apart from the management of geopolitical risk at specific portfolio companies, which has to be actively managed as well, us as Mubadala, as a sovereign and a longer-term investor, I think we're quite comfortable taking on these geopolitical risks.
Okay. Alex, between Asia, Europe, and Africa, you're the CEO of this region. Your approach differs based on the players and whatever the causes of this risk in each of the geographic area, or no, you follow a specific approach dictated by the corporate interest, because definitely you have different line of businesses. Same applies to Dr. Helen, of course.
We do, thank you. I think when you look at it through the lens of clients, and let's take industrial clients, corporates as a good example, and let's start with Europe. I think what has happened over the last 3 years was probably most impactful to those type of clients than anyone else, right? You think about the 3 big vectors of stability that they were enjoying. They were operating in a very safe environment, thanks to the friendship to the US and NATO participation. They had cheap energy from Russia, and they had China as the single biggest market to sell their products to, right? So in the space of a couple of quarters, these 3 big pillars kind of collapsed or are at risk of collapsing. So geopolitical risks, let's call it, is something that is grinding into the thought process and has to grind more into the thought process of corporate leaders all around the globe. You're seeing obviously the first effects taking place. A lot is being discussed around supply chain diversification. That is one factor of it, but it's not just geopolitics. It's also the learnings from COVID that are coming in there. But I think we're only at the beginning of this. Yeah. So one vector is obviously a need for investment and diversification for corporate leaders to sustain potential future shocks, potentially coming from the geopolitical scenery. The other aspect to it is, I think a degree of quantification, something that, investors, banks are doing day in, day out. It's part of our business to stress test our activities, our exposures and the like. Corporates usually have a different set of risks that they are operating with, right? They have their credit risks, they have their liquidity risks, demand changes. But geopolitics, in the Western Hemisphere at least, are a somewhat new item. And that's something that really, companies need to train the muscles to develop that. It's something we find ourselves as Deutsche Bank very much engaged on, in particular with the multinational corporates, It's also, by the way, something that is changing the banking industry quite a bit as we speak. Think about the stereotype industrial that historically has had a part of the supply chain exclusively performed in China or another location. Chances are the company would now look at a second and third factory in addition to the Chinese operation. So they need to move into locations they've never been before. That obviously always comes across with financing needs, comes across with cross-border banking needs, risk hedging, risk advice. Frankly speaking, it's very good for banks like ourselves, because with the broad network that we have, and particularly in those markets that are benefiting, call it the Global South, with all our activities, entities, and licenses we have there, there's a lot of activity going on, and I think we're only starting to see the very first items of that change.
Raphael, from an investor perspective, are things much easier to explain, since Dr. Helen mentioned that she talks to clients almost every day, being based here in the region and at the same time looking at opportunities across maybe different geographic areas, and how geopolitical risk really makes sense in terms of impacting your asset allocation once it's there and you can do nothing about it?
Yeah, it's interesting to note that geopolitical risk is on the rise, and when you ask investors what are your top concerns for 2024, in the list very high up you have geopolitical risk. So it's clearly something you have to deal with as an investor, as an allocator. The question is how, and that's a tough one, obviously. Our view is to say, do you need to hedge geopolitical risk per se? It's very difficult. It's very difficult because you don't know when, you don't know how, and oftentimes, even if you were knowing anything about it, you would be wrong, taking the wrong position, think Brexit, think the Trump administration, and so on and so forth. So as opposed to trying to anticipate or hedge, the view we're taking is try to understand what are the long-term consequences of having such a rise in geopolitical risk. What does it mean in terms of the market structure, the market regime? Where is it coming from? How come we've had so many geopolitical events the past few years? Is it a coincidence, or is it hiding something else? Mm-hmm. And when we look at it this way, and taking a very market and macro approach, the way we see it is really we are kind of in a shift in terms of market regime, a shift in our economies. We are slowly getting out of a probably over-optimized, globalized, capitalistic world, mm-hmm. which is turning, an over-optimized world looking at supply chains, looking at chains of production, looking at fiscal regimes, financial engineering, towards something which is going to be more local, more sustainable. And the rise of geopolitical risk is probably due to the fact that this is happening as we speak, and this is creating tension in the system. So the question for us is more, okay, what is this new investment space is going to be like? How do we adjust our allocation based on it? Mm-hmm. What are the consequences for long-term investors for the next 3, 5 to 10 years?
We'll talk definitely about opportunities, but going back to Dr. Helen, he mentioned hedging. When you have different line of businesses and different types of clients with different objectives to talk and to explain how this geopolitical risk is impacting your portfolio as a bank, on behalf of shareholders and investors you represent, how complicated it is, and we all get the same information. The way we digest it, read between the lines, and assess it, the measures that should be taken differs definitely. Any measure, any assessment that maybe is better to follow when it comes to all these risks together, economic and political at the same time?
So it's a great question. I don't think there's a single answer to that question. And when I'm in the region, I'm often asked about whether there is some sort of artificial intelligence platform that can give us all the answers. Uh-huh. And fortunately for me, there isn't yet that I've seen. And it's really a factor of a few things that you've identified. We all have the same access to information. I don't think that's necessarily true. I think the sources of information need to be as expansive as possible. And I think sometimes when we do get the wrong answers, it's because we have one lens through which we look at the world, a groupthink, the same sources. If you only look at some Western sources, you might only get Western answers. So I think it's important to have as diverse an array of information as you can, particularly, and what I ask for from some of our consultancies that we deal with, is the strange guy in the corner who's saying something eminently different from what everybody else is saying. I want to know what he has to say. So that's one piece of it, the sources, the networks of information, the academic expertise, some methodological rigor, so that when you don't have the answers, you look at scenario development, you look at what the world might look like, so you can stress test against that and start to help hedge, navigate. But you're right, with the portfolio the size of HSBC, with us operating in 62 markets, we're the world's largest trade finance bank. On that basis, a lot of our customers have different questions and different risks that they face. So we look at them and we cut them in a variety of different ways. There are the macro risks, which are likely to affect the global picture, but then we break it down into country risks, into segment risks, depending on the sectors that are involved, into individual risks. But what we try to do, again, is narrow the uncertainty. That doesn't mean we can eliminate it. That would be ideal. But we narrow it to the point where we can manage it and develop risk appetite and strategy accordingly.
Okay. Ahmed, definitely hedging should be part of any investment strategy. You are a global player. You cater for different asset classes and at the same time different risk level. How also you foresee or you see things evolving going forward, knowing that 2024 so far we haven't seen any major or at least solution cooking, for the major conflicts globally, and you are still expanding because definitely your time horizon, like you mentioned, is multi-generational.
No, I think from our perspective, I think the way we think about sort of opportunities and risks is you have to start with your deep convictions in terms of sort of the sectors, the asset classes of importance to you. From our perspective, our strategic asset allocation at the high level guides where we deploy. Then we overlay that in terms of sort of the different lenses that we have, the geopolitical risk that is the topic here. So I think we take a step back and say, okay, these are the areas, these are the geographies that we believe in, that have structural tailwinds, the themes of the future that we believe in, where we have strong convictions, be it sort of the shift to Asia, the aging population, sort of the energy transition. So I mean, all of these mega trends and themes, you need to have these convictions and have it front and center. And then you overlay that in terms of sort of the where you play. We have decided that we are underweighted Asia, and we've decided to sort of allocate to Asia, even China, even with all of the geopolitical tensions between the U.S. and China. We still believe that, from a diversification perspective to our portfolio, we need to be in China. But again, the geopolitical tensions also color the way you invest. So again, we're more careful in terms of the sectors we invest in China, because again, our biggest market still is the U.S. So again, I think you have to be very careful, in even if you have these deep convictions. You need to be careful in terms of where you invest and how you invest. But nevertheless, we deploy. We continue to deploy in China. Of course, Khaldoon mentioned previously that Asia, Japan, South Korea, India, no doubt, are big markets for us. We're also allocating to sort of other areas, even Europe, given the geopolitical tension with the Ukraine war. And the impact, again, you have to take that into consideration, but it doesn't mean, at least for us as a sovereign investor, an investor that takes a longer term sort of view, it doesn't necessarily change our allocations or our plays. It just means that it has to be moderated at times. It has to be paced probably in certain areas a bit differently. But again, your convictions need to guide your investments.
Alex, going back to the economic impact, some people think that globalization as we know it is getting weaker and weaker, and we see more protectionism now on the rise. We all know, and we are all waiting for the US election, and we know the different scenarios that might play accordingly. You see this contributing more to being a global player with local presence and understanding of each local market separately within definitely the strategy that you have as a bank, or no, life will go on as usual and we have to adapt and adjust accordingly?
So life will not go on as usual, right? But at the same time, I would say globalization is not over. Again, take the anecdotal evidence of a European corporate now thinking about a second and a third leg of his production scenery and endeavoring into Southeast Asia, right? So in an ironic way, you're having more globalization as a result of this, as people need to diversify. Then there's also there's a lot of talk about this, but the globalization will not disappear, but it will get more complex. Yeah, and we talked a lot about the inherent risk management that needs to come along with it. You need to quantify it. You need to be able to absorb it. You cannot hedge everything. You can limit it. You need to quantify it, and you need to be able to survive any such shock event and black swans, if you like. But as a consequence, you also need to look at the markets more on an individual basis down the road, again, in order to understand when the music stops, as in Russia.
How easy it is to really segregate markets when you have a global phenomenon impacting every single market on one hand, and at the same time moving to opportunities? Definitely, I need your input, all of you, please. How you look at opportunities, from these same markets where you have conflict, you have economic kind of risk, and at the same time, financial uncertainty.
So I view this really as an opportunity. It comes to Helen talked earlier about the volatility has two drivers, and it's exactly the question on whether you are able to adapt to those vectors or not, and there will be consequently winners and there will be losers. Having a strong network across so many jurisdictions, in particular those that are benefiting from it, and I will mention this part of the world as a big beneficiary of everything that's happening, that is a key in order to succeed. But you also need to be very conscious of the fact that, again, the intrinsic costs that come along with this diversification, supply side, demand side adjustments, all of that will be leading to inflation. So you need to also manage this part in order to stay competitive with your products. But again, from the perspective of a bank, it's good for business if you serve such an array of countries. How do we translate that into action at Deutsche Bank specifically? We are investing very heavily actually into, in particular Middle East, Africa and Asia Pacific. In particular, Middle East versus Southeast Asia is going to be the single biggest growth corridor on the planet for the next 5 to 10 years. Okay. And what that means is also that, alongside obviously the demographics that we already have, alongside the GDP relevance, both in absolute and relative terms, and those trade corridors becoming more relevant that will not see the US or Europe participating the way they were part of the story in the past, means you need to be even more dominant and relevant in the market, and that's why we are putting more resources on the ground. And ultimately, I think that's great news for the Middle East, it's great news for UAE, and it's great news for Abu Dhabi.
Okay. Rafael, how you look at the region also, and at the same time, pre-pandemic and post-pandemic, this is also a risk that nobody even thought about or expected or knew even after the breakout how to deal with. How investors now are more receptive in terms of risk tolerance, their appetite to maybe wait for a longer term, and at the same time deal with things from a more rational perspective rather than, emotionally, because definitely between individual and corporate things differ, but you have to justify what's happening.
Yeah, we can say there is clearly a shift in the way investors, broadly speaking, and us at Tikehau, we look at investing in this context. Obviously, with rising uncertainty, a deglobalized world, barriers to entry, customs, the fact that we are re-onshoring left and right, the energy transition, and I thought Professor Bourguignon did a very compelling case to explain the cost that is ahead of us collectively to make this transition. We can expect that growth will be weaker going forward. It's going to be weaker, it's going to be more local, and this is why it's so important to be here on site, investing alongside our clients locally as opposed to globally. And it's going to be probably more centralized within a few very specific mega trends that we talked about around resilience, about sovereignty, about the idea that now countries are waking up with the idea of a vulnerability on the back of COVID, on the back of Ukraine, on the back of the Trump administration, trade wars, and funding this resilience, both with public and private capital, is going to be key for performance going forward. So that's going to be one aspect we look at things, weaker growth, but more local. Another one will be with rising uncertainty, rising geopolitical risk, you need fatter risk premiums. You need to be very demanding where and when you invest. You need to be paid for the risk. The era of the 2010s where, liquidity was free and capital has no value is over. Liquidity has a cost, capital has value, and so in that case, you need risk premiums, and looking back at where the market is today, you can argue that there might be some more work to be doing on the risk premium side. Maybe one last consequence long-term for investors is the return of, inflation as a structural pattern. We can argue that part of the inflation cycle we've had was cyclical with COVID, Ukraine, that probably this cyclical part of inflation is now gone. And now we are left with the structural part, with the cost we just described, deglobalization, re-onshoring, energy transition. All of that will have lasting consequences, which means for an investor, higher interest rates for the long run. The potential also to go back into strategies which were long forgotten, carry, compounding, income. Clearly now it's part of a portfolio, doing liquid credit, private debt secondary, special situation. Arguably fixed income is in a very sweet spot right now. You have healthy companies with strong balance sheet and very resilient earnings, which are financing themselves off the risk-free rates, which has shot up dramatically. And today, you can compound in the fixed income space with high-quality companies in the 6, 7, 10, 12% area, providing a mattress for investors in terms of carry, and allowing for some risk-taking in those mega trends we were discussing about through private equity, through equities, etc. So in our view, this is a new paradigm and part of the consequences of this probably lasting geopolitical landscape. It's a shift in terms of the way we invest, and at Tikehau, it means, being very local, very focused on mega trends, and finance quality companies to compound over the long run.
Okay. Dr. Helen, when you manage risk properly, in a very transparent way, we have proper governance, definitely you are at the same time reflecting positively on your image and you're managing your reputation. How this is important now, knowing that not a long time ago, global banks were really under the spotlight, and this is something maybe it's forgotten for a short period of time, but will always resurface whenever there is any big question mark on their whether behavior or approach.
Absolutely. Well, I think the reputational question is important, not just for financial institutions, but for corporates writ large. And I think it's increasingly tied. There's a nexus between geopolitics and reputation and brand. And we've seen that over the course of recent weeks as well in this region, and as well with the Russia-Ukraine crisis. So I think the risk management, the geopolitical risk management, operating within the framework effectively of reputational risk management and enterprise risk is critical, not just for financial institutions, but for all multinational corporations. And I think what Russia-Ukraine also showed us was the capacity for civil society and activist investors to drive decision making. And I think that there needs to be a good deal more thinking around the impacts, that nexus between geopolitics, reputation, and planning and strategy.
Okay, let's talk opportunities now. Let's be more positive. Enough drama. I want to start with Ahmad. You mentioned different markets you're interested in, you're already in. Maybe you look to increase, expand more. I want more specific sectors. Everyone now is talking about AI. Last year it was VR. Next year, who knows which alphabets will be. But definitely, with all the crises around, with all the conflicts around, technology is getting better and better. Progress 20 years ago till now, a huge leap. Which sector you look more in depth to, and which industries maybe you think they are still at an early stage of development and maybe nobody realized the real potential of them?
Hisham, I'll come back to this question, but maybe I pick up from what my colleague had mentioned, because I think I agree with him and I sometimes disagree a little bit in terms of sort of investor appetite. And I agree investors today are a bit more cautious in general, no doubt. But I think this is an area, this is a period of adjustment, because change and uncertainty is the name of the game for the foreseeable future. So I think the multipolarity in the world is there to stay. The sort of the tensions east and west is there to stay. So I mean, this is a reality that investors will come to accept. And as investors come to accept this new world, I believe that sort of the premiums that investors are asking will probably come down. But today, I think it is totally understandable for investors to be asking for premiums, sort of for the risk that they're taking in this multipolar, distressed world. But nevertheless, I think there is a lot of dry capital that is sitting on the sidelines in the West and in the region that is looking and eager to deploy in opportunities and areas. And I think we've seen sort of certain geographies that have benefited from this geopolitical risk. I mean, you look at Morocco, for example, benefiting from the East-West tension. Mexico, for example, is another geography. And then you also have sectors that are also that have not necessarily benefiting from the geopolitical issues, but have these structural tailwinds that will carry them through this turbulent time. Technology and AI is no doubt an area that has been much talked about, but again, the structural shift that has come about as a result of the AI revolution, this will continue to carry on for the next few years at least, where I think there's a lot of money to be made in technology and AI-linked sectors. So this is an area where we believe in. The energy transition is an area that I think is resilient to geopolitical tensions. You look at Europe, for example, even in areas where valuations have been hit, where there has been sort of a bit of a distress, companies that are in the energy transition space have fared well and have been trading at premiums and are excellent targets. The changing consumer patterns and companies that are capitalizing on that, be it in the West or even in the East, I think will stand to benefit from even in this turbulent time. So I think there are definitely a number of sectors and areas that I think will continue to do well, and where we're focusing on that I think even with this environment, I think it's safe to say these are good bets.
Okay, Alex. When it comes to opportunity and risk appetite, do you think money now flows much faster to grab opportunities, regardless of any unexpected event, or no, it's still the same old strategy? The risk-return equation should be always taken into consideration, knowing that if we look at some performance of some equities or companies, you rarely see someone now talking about PE or price-to-book ratio or all this stuff when they look at the percentage increase or return on investment in a short period of time.
I mean, the risk return always needs to be brought into the equation, and it's happening to this day. If you look at the Chinese stock market and how it has developed over the last year or two, it's clearly a reflection of uncertainty and also geopolitical aspects, undoubtedly. But I think in terms of overall monetary flows, money has always been fluid. It will continue to be fluid. And it will also lead to a development of financial markets and investment universes very clearly, right? So what do I mean by that? If I ask you what are the 2, 3, 4 largest capital market centers in the world, you will probably give me names that are located somewhere in the G7 nations. And that's logical because of the past dominance, right? But then if you do a proper mark-to-market, the 7 largest emerging countries in the world have an aggregated GDP that is already larger than that of the G7. As a consequence, it's logical that financial markets will also have a drift towards those jurisdictions. Now, what is in technological advancement and the fact that you don't need to necessarily be physically present in a stock exchange the way you had to 50 years ago, mean that this type of movement and the relevance of financial centers is also changing very, very fast. Now, if you fulfill certain criteria to be an attractive location for such activities, what are parameters? Obviously, you need to have and create an environment and an infrastructure that makes it attractive for foreigners also to work there. You need to have a sound and experienced legal environment for businesses to accumulate activities. You need to have a straightforward tax regime. And you ultimately need to have a positive attitude towards business and development. And I think this is very much why a number of locations like Abu Dhabi can very significantly benefit. And it's not a zero-sum game. It's not about rehubbing from one location onto the other. Take it the Brexit experiences, right? London is not over in terms of relevance. Bits and pieces moved to Paris, to Frankfurt, to Amsterdam, to Dubai. Mm-hmm. But ultimately, the world is moving, as we discussed the entire morning. And as a consequence, the evolution of financial centers is going to evolve.
Okay. Rafael, talking about the region, Abu Dhabi, Dubai, even what's happening now with the huge project in Saudi, Neom, you think investors are aware of opportunities? Because before, it was only look to the West for great opportunities. Now things, if you look at the investment made in this part of the world, it's a huge, plus a major factor, stability. How also this should be really put on a radar and made not only clear, well understood for the long term from an investor perspective, because I know you talk more on behalf of investors.
Yeah, clearly there is an increased focus clearly among the investment community on the Middle East region for exactly the reasons you are describing. When you look around, the US is in a fairly, I would say, highly wired political state right now, and 2024 will be a bumpy road. Far East Asia is also suffering in some ways from the trade tensions with the US and the political risk of a potential Trump administration. Europe is suffering with a war on its soil and tepid growth. And so at the end of the day, when you look at where is capital being allocated, where do you have dynamics of inflows, investment, innovation, a lot of it is in the Middle East. So as an investor, broadly speaking, when you look around, this is one of the places where you have to focus. Then on those mega trends, which could be the ones performing over the long runs for investors, what do we do here? We're talking about, for instance, obviously energy transition.
Yes.
We're moving on to regenerative agriculture as another way to have a more sustainable growth and less carbon being produced. Looking at aerospace, looking at defense, looking at many of those long-term trends around this resilience theme. A lot of it is also happening here on the ground. A lot of investors in those mega trends are actually coming from the Middle East.
Yes.
So clearly, the Middle East is center on the map today, and for investors, one of the last bastion of innovation, agility, growth in what is a very uncertain world around us. Yeah.
Thank you very much. Unfortunately, this is all the time we have. I want to thank you again, Mr. Ahmad, Dr. Helen, Mr. Alex, and of course, Mr. Raphael. Thank you for your input. Understanding definitely the complexity of these factors is very essential for any informative decision for all, whether policymaker, asset managers, and definitely things keep on moving and changing, and always expect the unexpected. Thank you again for being here.